As of the latest market close on June 18, 2026 at 4 p.m. Eastern Time, BigBear.ai Holdings, under the ticker symbol BBAI, officially settled at $3.92 per share, marking a modest intraday gain of 1.03% on a trading volume that outpaced its long-term baseline. While casual market observers looking at standard data feeds might view this minor tick upward as a routine stabilizer in a volatile microcap software chart, the underlying institutional options flow tells an entirely different story that most retail participants are completely missing. A massive chunk of the recent volume spike is not driven by long-term accumulation, but rather by highly sophisticated hedging structures designed to capitalize on the widening gap between federal award announcements and actual liquid cash realization. This structural delay creates a unique operational bottleneck where paper wins do not immediately translate to balance sheet strength, creating an intricate setup that challenges the conventional wisdom surrounding microcap artificial intelligence plays. When people talk about small-cap technology investments, the general expectation is that these agile software providers will experience explosive hypergrowth the moment they secure a major government partnership. The common consensus across retail forums is that because this firm operates within the same general ecosystem as massive computing giants, it is bound to catch a secondary wave of momentum that could mirror the historical trajectories seen in high-profile assets like Apple stock or Nvidia stock. Many individual brokerage accounts have loaded up on these shares with the belief that a low nominal price provides an asymmetric risk-reward profile. The prevailing narrative suggests that a contract win with the federal government or the military should automatically serve as an undeniable catalyst for a sustained upward breakout. However, the harsh economic reality completely subverts this expectation. In truth, federal procurement cycles are notoriously slow, heavily audited, and plagued by razor-thin margins that can easily compress under the weight of rising corporate administrative costs. While everyday self-investing enthusiasts expect immediate top-line transformation, institutional analysts look directly at the cash flow statement, where persistent operational cash burn reveals a much more challenging environment. The company has to absorb substantial upfront engineering and compliance costs before a single dollar of contract funding is officially paid out, meaning that rapid expansion can paradoxically strain their near-term liquidity. This creates a stark disconnect where retail optimism runs high based on headlines, while capital allocators remain defensive, scrutinizing the company's ability to maintain structural solvency without turning to dilutive equity financing. Taking a close look at recent trading behavior across prominent online investing venues, the stock has experienced significant friction near the $4 psychological resistance zone. For instance, data from the Robinhood app and wider Robinhood stock trading circles indicates that retail interest spiked heavily during the earlier seasonal rallies when the stock attempted to clear its 52-week high of $9.39, but subsequent drawdowns toward the $3 floor have trapped a substantial amount of retail capital. When you observe retail activity through a Fidelity brokerage or track order flow across the broader Fidelity trading platform, you can see a noticeable shift from aggressive call option buying to passive equity holding. Long-term accumulation patterns on platforms like SoFi Invest suggest that while smaller participants are utilizing features like Robinhood fractional shares to slowly build positions, institutional block trades are executing sophisticated distribution strategies, selling into temporary spikes to mitigate their exposure to small-cap credit risks. This balance between retail enthusiasm and institutional skepticism is vividly illustrated by how the stock is treated across different investing sites and brokerage tools. Users managing their own portfolios through self-investing accounts often compare these metrics to massive enterprise models, whereas automated algorithms, such as those governing a Schwab Intelligent Portfolio setup or a typical SoFi Robo-Advisor asset allocation, frequently classify the stock under high-volatility speculative categories, maintaining minimal exposure due to negative earnings per share. If you look at the sophisticated clearing data available on an interactive broker's platform, the short interest ratio has remained stubbornly elevated, proving that a dedicated cohort of professional market participants is actively betting against the company's ability to sustain its valuation without achieving near-term profitability. This divergence in sentiment shows that while the retail crowd looks for the next multi-bagger opportunity, professional traders utilizing an interactive broker's account are focused tightly on macro liquidity drains and cost of capital pressures. To truly understand why the stock is behaving this way, we must look at the specific technical setup and recent institutional momentum. Over the past several quarters, the trading volume on the New York Stock Exchange has routinely experienced massive intraday anomalies, where tens of millions of shares trade hands in concentrated blocks without causing significant net price appreciation. This layout typically indicates heavy institutional churn, where early-stage private equity entities or debt holders are gradually exiting their positions, absorbing the buying pressure generated by retail traders who are seeking help with investment decisions via public forums. When everyday retail buyers execute trades on a Fidelity mobile app, they often see a highly liquid asset, but they fail to realize that this liquidity is being provided by institutional sellers who are eager to reallocate their capital towards safer yield-bearing Fidelity mutual funds or highly liquid Fidelity ETFs. This creates an environment where the stock feels like it is building a base, but it is actually experiencing a prolonged period of equity distribution. At this point in the analysis, let us pause for a quick gauge of our community's positioning in this specific asset class. Please comment below how many shares of BigBear.ai you currently hold in your portfolio, and state whether you are using a traditional individual brokerage or an automated robo-advisor platform to manage your position. Gathering this structural data from real market participants helps us understand whether the retail float is consolidating or becoming increasingly fragmented across the wider investing landscape. To properly evaluate what lies ahead, it is necessary to step back and inspect the foundational infrastructure of what this enterprise actually does. Stripping away the complex marketing terminology, the firm is fundamentally a specialized provider of predictive analytics and machine learning software, tailored heavily towards defense, national security, and complex logistics infrastructure. Their primary business model revolves around capturing long-term tournament contracts, where they deploy software suites designed to aggregate disparate data streams, identify operational anomalies, and assist military decision-makers with real-time situational awareness. In addition to their dominant public sector footprint, they have spent the last few years attempting to scale their commercial enterprise, offering predictive maintenance tools and supply chain optimization software to corporate entities that are desperately trying to protect their profit margins from global shipping disruptions and inflationary labor constraints. However, historical financial reports confirm that scaling a commercial software business is a vastly different challenge than fulfilling a highly customized defense contract. In past fiscal periods, the company's older earnings reports have consistently highlighted a heavy reliance on a small handful of government entities for the vast majority of their total revenue. This concentration risk means that a single federal budget or a shifted procurement timeline can completely disrupt an entire fiscal year of projected revenue growth. Furthermore, legacy acquisitions meant to accelerate their commercial presence have introduced significant integration hurdles, resulting in non-cash goodwill impairment charges that have weighed heavily on net income, leading to the negative trailing price-to-earnings ratios that cause automated platforms like SoFi Invest or Schwab Intelligent Portfolios to restrict active accumulation flags. When examining the specific technical indicators on the daily chart, we see that the stock's failure to maintain its footing above the 50-day moving average has triggered automated selling programs across various self-investing applications. This technical breakdown often accelerates momentum to the downside because quant algorithms used within modern portfolio management systems such as a Schwab Intelligent Portfolios or a high-end Fidelity wealth management framework automatically reduce risk allocations when a small-cap stock exhibits extended relative weakness compared to the broader indices. The trading layout over the past month shows a clear pattern of lower highs and lower lows, which directly contradicts the hyper-bullish sentiment found on social media platforms. Retail traders utilizing the Robinhood app to chase momentum are often caught off guard by these quiet algorithmic sell-offs because the visible interface of many popular investing sites emphasizes simple price movements rather than the complex depth and market metrics that dictate professional capital deployment. To look closer at the underlying data, the institutional ownership structure currently shows that prominent asset management firms hold a combined stake of roughly 40% of the outstanding float, with entities like BlackRock and Vanguard adjusting their positions marginally during the last reporting cycle. However, this institutional presence is largely passive, tied directly to small-cap index replication rather than active high-conviction buying. This means that when retail investors see large institutions listed as top holders on a Fidelity trading platform or an Interactive Brokers platform, they are often misinterpreting passive index fund inflows as active validation of the company's business model. In reality, if the broader small-cap index faces downward pressure due to macroeconomic factors like sustained high interest rates or tightening corporate credit facilities, these passive funds are legally required to sell shares indiscriminately, regardless of any individual contract wins the company might announce. This passive distribution mechanism creates a hidden layer of market risk that self-investing retail accounts rarely account for when building a concentrated position. Furthermore, we must address the specific mechanics of the company's commercial expansion strategy, which has historically been touted as the primary driver for future margin expansion. The corporate leadership team has frequently stated that by transitioning from custom software development to a repeatable software-as-a-service model, they can achieve the high gross margins typical of enterprise software leaders. Yet the operational reality revealed in recent quarterly filings shows that commercial customer acquisition costs remain prohibitively high, especially in a market where corporate technology budgets are under intense scrutiny. When mid-sized logistics and manufacturing firms look for investment help to optimize their operations, they are increasingly choosing established platforms with massive support ecosystems rather than niche predictive models. This competitive dynamic forces the company to invest heavily in specialized sales forces and bespoke engineering, which ultimately keeps their operating expenses elevated and delays the timeline for achieving sustainable net income profitability. For individuals managing their own financial portfolios through a Fidelity brokerage account or a SoFi active investing setup, this structural delay means that patience is not just a virtue, but an expensive capital requirement. Holding an asset that consistently burns operational cash means missing out on the compounding returns available in alternative market segments, such as highly liquid Fidelity ETFs or stable dividend-paying assets. This opportunity cost is a critical component of the expectation versus reality framework. While an investor might expect a sudden 300% rally based on a new defense contract headline, the reality of a stagnant or slowly declining stock price can erode their overall portfolio performance over an extended horizon. This is precisely why professional asset allocators utilizing sophisticated Interactive Brokers trading systems place such a heavy emphasis on capital efficiency and cash flow generation rates rather than speculative forward revenue multiples. Let's also look at the macroeconomic pressures that are currently weighing on the entire small-cap tech sector, as these external forces have a massive impact on how individual tickers are valued by the market.
In an environment where the central bank maintains a restrictive monetary stance to combat persistent core inflation, speculative growth companies that lack current earnings are systematically penalized by the market's pricing mechanisms. The cost of rolling over corporate debt or securing new credit lines has surged significantly over the past 2 years, meaning that companies with negative cash flow face a much steeper hill to climb to fund their daily operations. When automated advisory systems like a SoFi robo-advisor or an intelligent portfolio algorithm evaluate these risk factors, they automatically tilt allocations away from microcap software firms and towards stronger balance sheets with deep cash reserves. This institutional capital flight creates a persistent headwind for the stock, making it incredibly difficult for the price to sustain any upward momentum without an absolute blowout earnings report that completely upends the current bearish thesis. As we look toward the upcoming corporate earnings call scheduled for August, the threshold for a genuine structural breakout remains incredibly high. Market participants using the Robinhood trading platform or tracking metrics on popular investing sites will be looking closely at the forward guidance provided by management, specifically concerning their contract backlog realization rate. If the company can prove that they are successfully converting their massive reported backlog into